Our learning objectives include distinguishing financial accounting from management accounting, understanding how management accountants help firms make strategic or long-term decisions, describing the set of business functions in the value chain, and identifying the dimensions of performance that customers are expecting of companies. We'll also explain the 5-step decision-making process and its role in management accounting. That is, to set a framework for how we make decisions in business and how management accounting might facilitate that. We'll describe 3 guidelines management accountants follow in supporting managers. We'll understand how management accounting fits into the organizational structure, and we'll understand what professional ethics mean to management accountants. Management systems are used to record economic events and transactions such as sales and the purchases of materials, and then process the data into a format that is helpful for managers and others. Management accounting is the process of measuring, analyzing, and reporting financial and non-financial information that helps managers make decisions. Financial accounting has a focus on the financial information that is disseminated to external parties such as investors, government agencies, banks, and suppliers. And so from this, what we're saying is that management accounting generally has an internal focus, while financial accounting, with regard to creating and developing financial statements, the income statement, the balance sheet, the statement of cash flows and such, and the notes to those financial statements generally has an external focus. Management accounting is generally done inside an organization, and you have management accountants, some of whom may be CPAs, but financial accounting is predominantly a profession practiced by CPAs. Cost accounting provides information for both management and financial accounting professionals, has its function on the cost of acquiring or using resources in the organization. And in this slide, a graphical representation highlighting the major differences between management and financial accounting is presented. The categories compared are the purpose of the information, the primary users, the focus and emphasis, the rules of measurement and reporting. For example, financial accounting must follow generally accepted accounting principles, or GAAP, whereas management accounting information is based on a cost-benefit analysis. And then time, span, and type of reports and behavioral implications. And so what we see down the left-hand column are the categories that we are talking within, and on the right-hand columns we see how management accounting and financial accounting fits into those. For instance, if we talk primary users, management accounting has as its primary users managers of the organization, whereas financial accounting has as its primary users external users such as investors, banks, regulators, and suppliers. If we look at behavioral implications, management accounting is geared toward designing and to influence the behavior of managers and other employees, again internal to the organization, whereas financial accounting is primarily reports economic events, but also influences behavior because managers' compensation is often based on reported financial results. And then finally, we look at something like time span and type of reports. Management accounting varies from hourly information to 15 to 20 years worth of information, with financial and non-financial reports on internal designations such as products, departments, territories, and strategies, whereas financial management typically is characterized with respect to time and type of reports regarding annual or quarterly financial reports, primarily on the company as a whole. So you can see there's a significant difference between some of these categories with respect to what the role of management accounting is versus the role of financial accounting. Deciding between two broad strategies of cost leadership or product differentiation is a critical part of what managers do. Management accountants work closely with managers in various departments to formulate strategies by providing information about the sources of competitive advantage, such as company cost or productivity or efficiency advantage relative to competitors, or premium prices a company can charge relative to the cost of adding features that make its products or services distinctive. And really what we're saying here is that increasingly the organization is looking to management accountants to provide value-added team support to making decisions that are strategic in nature. Many years ago, it used to be that management accountants were really just reporting historical information closing the books for the month, closing the books for the year in preparation for a financial statement audit. But now management is looking toward management accountants to be part of the team that decides strategically where the company is going, strategic decisions such as pricing or capacity utilization, and really looking to management accountants to be more value added than the traditional historic reporting mechanism and function that they previously served. Management accounting information helps managers formulate strategy by answering questions such as, who are our most important customers and how can we be competitive and deliver value to them? What substitute products exist in the marketplace and how do they differ from our own? What's our most critical capability? Will adequate cash be available to fund the strategy, or will additional funds need to be raised? And so you can see these are very contemporary, future-looking questions that have a big difference between what did we do, what were the results of our operations last month, or how much profit did we make last month, or what were our cost of goods sold for last week or last year. So you see the role of a management accountant is becoming much more strategic and much more forward-looking and much more focused on being value-added partners to the management of the organization overall. Customers demand much more than just a fair price. They expect quality products delivered in a timely manner. That experience is the value derived from purchasing a particular product or service. The value chain is the sequence of business functions in which a product is made progressively more useful to customers. The value chain consists of research and development, that is, generating and experimenting with ideas related to new products, services, or processes. The design of products and processes, including the detailed planning, engineering, and testing of products and processes. Production, which includes the procuring, transporting, and storing, coordinating, and assembling resources to produce a product or deliver a service. Marketing, which is promoting and selling products or services. Distribution, including processing orders and shipping products or services to customers, and customer service, that is, providing after-sales service to customers. Here we have a pictorial view of the value chain. In addition to each of our functions previously discussed, you see administration as an additional function. This includes accounting, human resources, information technology, and supports the 6 primary business functions. Management accounting provides information to inform each of these functions in the value chain. Part of management accounting emphasizes integrating and coordinating activities across all companies in the supply chain to improve their performance and reduce costs. Production and distribution are the parts of the value chain associated with producing and delivering a product or service. These two functions together are known as the supply chain. The supply chain describes the flow of goods, services, and information from the initial sources of materials and services to their delivery, regardless of whether the activities occur in one organization or in multiple organizations. To increase efficiency in these areas, in other words, to increase performance and reduce costs, suppliers may be asked to deliver small quantities of materials frequently instead of one larger shipment. Sometimes we refer to that as just-in-time inventory. And there are these types of practices that, again, increasingly management accountants are becoming involved in providing input to and shaping and molding the results of. And so keeping that skill set current and being able to talk in terms of inventory control or be able to talk in terms of market share or product delivery are all important and increasingly or growing skill sets that accountants need to develop. The key success factors to improve performance are shown here. Cost and efficiency, including understanding the activities that cause costs to arise and managing them, allows managers to react to the continuous pressure to reduce cost. Quality considerations, inasmuch as customers expect high levels of quality all the time. Time. Two important dimensions of time are new product development and customer response time. Innovation, and that is maintaining a constant flow of innovative products or services, is the basis for the ongoing success of the company. And then sustainability, the development and implementation of strategies to achieve long-term financial, social, and environmental goals. And so here we talk about the 5 steps in the decision-making process in planning and control. And again, these are just, this is one framework. There are multiple frameworks out there that deal with decision making, but this is one framework that provides a methodological, systematic, or consistent methodology to approaching a decision. And the steps include identify the problem and uncertainties. We obtain information. We make predictions about the future. We make decisions by choosing between the alternatives. We implement the decision and then evaluate our performance and learn. And we'll come back to this framework multiple times throughout the semester as we problem solve in specific management accounting areas. One of the 5 steps in decision making, the first 4 are planning and the 5th in control. So the first 4 are planning and the 5th step is control. And that's how we get to this idea of planning and control. The most important planning tool when implementing strategy is a budget. Planning selects goals, predicts results, decides how town results, and communicates this to the organization. Control takes actions that implement the planning process or decision, that evaluate the performance, and then provides feedback to the organization so that we have this ongoing loop with constant feedback and the opportunity for organizational learning. The guidelines shown here help management accountants provide the most value to the strategic and operational decision making of their companies. When we talk cost-benefit approach, we're talking about the benefit of an action or a purchase generally must exceed cost as a basic decision rule. This becomes important in accounting because, sure, we'd like to have all the detailed information available in the world. We'd like to have the time to analyze and process that information to come up with the best decision available. However, there's generally not enough time for that, and this approach becomes very expensive, and so we always are looking at things that cost the cost of accumulating, acquiring information, analyzing it, interpreting and understanding, versus the incremental value or benefit to our decision-making process that that additional time provides. We also talk about behavioral and technical considerations. People are involved in decisions, not just dollars and cents. And so with respect to this, we need to understand that sometimes the most logical decision based on the expected profit or expected return or some other accounting measure of performance is not the best decision, given that we have people in our company, we have resource considerations, and so we always want to take into account the behavioral and technical considerations. And then finally, we have different costs for different purposes. And here we're talking that managers use alternative ways to compute cost in different decision-making situations. And we'll talk about that when we talk about relevant versus irrelevant cost. We'll talk about it in terms of the different tools that we'll use, whether it's tools about budgeting, tools about variance analysis, or tools on how to interpret financial performance. All of these, not all of them, but many of these tools have different computational methods and definitely different interpretations of the results. And we just have to keep that in mind, and that ours is not the only interpretation, and that very seldomly is there only one correct answer. So the organizational structure depicted here shows the details of the CFO, or Chief Financial Officer position, who generally reports to the Chief Executive Officer. The CFO is sometimes called the Finance Director and is the executive responsible for overseeing the financial office or operations of the organization. So let's turn our attention to the idea of ethics. This is a very, very important area, and I can't stress how important it is that as accountants we understand our ethical obligations and responsibilities, and that we do not allow those to be compromised or sacrificed for any reason. So there are 4 standards of ethical conduct for management accountants as advanced by the Institute of Management Accounting, including competence, confidentiality, integrity, and objectivity. Ethics are the foundation of a well-functioning economy. Accountants have special ethical obligations given that they are responsible for the integrity of financial information provided to internal and external parties. So please keep in mind how important it is and how significant a responsibility we have as accountants, whether it's to internal users of the information who are going to make financial decisions or external users of the information who are going to make economic decisions, that we need to be transparent and we need to be honest, and our work needs to be engulfed with integrity and objectivity. And keep in mind that a tainted career is a poor legacy, and it's very difficult to recover from such. And so I encourage you to keep at the front of your mind always the idea about maintaining integrity and ethical conduct. And if ever a question comes up, I encourage you to contact a mentor. Contact the Institute of Management Accountants. These are not problems we have to deal with on our own, and sometimes just that extra ear or a different perspective will help us along and further down the right track. As part of the Sarbanes-Oxley Act, the CEOs and CFOs must certify the financial statements of their firm fairly represent the results of their operation. The Act focuses on improving internal controls, corporate governance, monitoring of managers, and improving the public disclosure practices of companies. And this Act came along as a result of, back in the early 2000s, the MCI and Enron scandals, the Titan scandals, and so or Tyco scandals, and so it really is geared toward it came about as a result of public pressure on legislatures because of the drastic losses imposed by these scandals, and it really is geared toward creating more transparency and in creating accountability for companies that are publicly traded. And so this concludes Chapter 1. It's really a high-level overview. We talked about a few of the important issues related to the management accounting profession and to management accountants in particular. We talked about some of the differences between managerial accounting and financial accounting. I hope I stressed the importance of ethics enough to impress on you how critical it is that we maintain a high level of ethical conduct. And with that, we'll move on into future chapters. I encourage you to go back and read the text, and do not let this lecture and discussion substitute as a good reading for the text. Thank you.